Every country on Earth is in debt, but here's the question no one ever asks. Who exactly is getting paid? Not politicians, not voters, and not the people you see on the news. Hidden behind balance sheets and legal contracts is a quiet network of creditors with the power to crash currencies, reshape governments, and decide the future of entire nations, without ever being elected. Once you see who really owns global debt, you'll never look at money, power, or politics the same way again. What makes this story fascinating is that the real creditors of the world are not always the ones you think. It's not just governments lending to governments, or institutions with famous logos. Much of global debt is held by entities that never appear in headlines, never give press conferences, and never face voters. Yet their influence can shape currencies, decide whether a country can fund hospitals or schools, and even determine whether a government survives politically. Let's start with a truth most people don't realize. Governments don't primarily borrow from other governments. They borrow from markets. When a country issues debt, usually in the form of bonds, those bonds are bought by whoever has the capital and the appetite for risk. That includes pension funds, insurance companies, mutual funds, hedge funds, sovereign wealth funds, central banks, and private banks. Each group has different motivations, timelines, and levels of patience. Pension funds, for example, are some of the largest creditors on Earth. They manage the retirement savings of teachers, nurses, factory workers, and civil servants. These funds need long-term, predictable returns, and government bonds, especially from wealthy nations, are considered among the safest investments available. That means when a country like the United States, Japan, or Germany borrows money, a significant portion of that debt is effectively owed to ordinary people's future pensions. Not directly, of course, but structural. Insurance companies play a similar role. They collect premiums today and promise payouts years or decades later. To make that work, they need stable assets. Government debt fits perfectly. Quietly, methodically, insurance companies have become some of the most reliable creditors in the global system. Then, there are mutual funds and exchange-traded funds. These vehicles allow everyday investors to buy tiny slices of massive bond portfolios. When you invest in a global bond fund, you may unknowingly be lending money to dozens of governments across multiple continents. You don't negotiate the terms. You don't vote on austerity measures. But your capital is still part of the machine. Now we move into more aggressive territory: hedge funds. Hedge funds are not the largest creditors by volume, but they are among the most influential. They specialize in buying debt that others want to get rid of, especially during crisis. When a country is on the verge of default, bond prices collapse. Hedge funds step in, buy that debt at deep discounts, and then use legal systems, often in New York or London, to demand full repayment. These are sometimes called vulture funds, and while the name is controversial, the strategy is real. Some of the most dramatic debt battles in history didn't involve tanks or soldiers, but lawyers and courtrooms. Entire national budgets have been frozen because hedge funds refuse to accept restructuring deals. In these moments, the creditor isn't just a lender, it becomes a political actor. But even hedge funds aren't the real giants. The true heavyweights of global debt are central banks. Central banks hold massive quantities of government bonds, both domestic and foreign. When a central bank buys government debt, it's not behaving like a normal investor. It's shaping monetary policy, controlling interest rates, stabilizing currencies, and sometimes quietly financing government spending. After the global financial crisis, and again during the pandemic, central banks bought unprecedented amounts of debt through programs often described as quantitative easing. What this means in practice is astonishing. Governments often owe money to institutions they themselves control. the line between borrower and creditor blurs. When a central bank holds government debt indefinitely and rolls it over rather than demanding repayment, the debt becomes almost symbolic. It still exists on paper, but its economic meaning changes. However, this only applies to countries with strong, trusted currencies. For developing nations, the story is very different. When poorer countries borrow, they often do so in foreign currencies, particularly dollars or euros. This immediately shifts power to the creditor. If a country can't print the currency it owes, it becomes vulnerable to exchange rate swings, global interest rate changes, and capital flight. A rising dollar can suddenly make a manageable debt unbearable. And this is where international institutions enter the story. The International Monetary Fund and the World Bank are often described as lenders of last resort. They step in when countries can't access markets on reasonable terms. But their loans come with conditions. These conditions are usually framed as necessary reforms: cutting subsidies, privatizing industries, reducing public spending, reforming labor markets. Supporters argue these policies restore stability. Critics argue they transfer economic sovereignty from governments to creditors. What's important to understand is that these institutions are not neutral. They are controlled by member countries, and voting power is weighted by financial contribution. That means wealthy nations effectively shape the rules. When a country borrows from these institutions, it isn't just taking money, it's accepting a new balance of power. But there is one creditor that has reshaped global debt dynamics more than any other in recent decades: China. China is now one of the largest bilateral lenders to developing countries in the world. Through state-owned banks and development initiatives, it has financed ports, railways, highways, power plants, and digital infrastructure across Africa, Asia, and Latin America. Unlike Western institutions, Chinese loans often arrive quickly and with fewer public political conditions. However, they come with their own complexities. Many of these loans are opaque, with confidentiality clauses that prevent public scrutiny. Some are secured against natural resources or strategic assets. When repayment becomes difficult, renegotiations happen behind closed doors. This has fueled debates about debt diplomacy. Is China intentionally trapping countries in unsustainable debt to gain leverage? Or is it simply behaving like any major creditor protecting its interests? The reality is likely more nuanced. But what's clear is that China is now a central player in the global debt web, and its decisions can ripple across entire regions. Yet even China doesn't operate alone. Sovereign wealth funds, state-owned investment funds built from trade surpluses or resource revenues, are another hidden force. Countries like Norway, Saudi Arabia, the UAE, and Singapore manage enormous pools of capital. These funds invest globally, including in government debt. When a sovereign wealth fund buys bonds, it's not just an investment, it's a strategic allocation of national surplus. At this point, the picture should be getting clearer. Global debt is not owed to a single villain or mastermind. It's owed to a sprawling, interconnected ecosystem of institutions, funds, and states, each pursuing its own version of stability, profit, or influence. But here's the part almost no one talks about. Debt is not just about money. It's about time. Creditors are making claims on the future. When a government borrows, it commits future tax revenues, future growth, and future political choices to decisions made today. Creditors, in turn, gain influence over that future. Sometimes subtly, through interest rates and investor sentiment. Sometimes explicitly, through conditions and negotiations. And the public? The public rarely sees the full picture. Debt agreements are often technical, written in legal language, negotiated by specialists, and discussed in forums far removed from everyday life. Yet their consequences are deeply personal. They determine whether a country can expand healthcare, invest in education, or respond to crisis. They shape inequality, opportunity, and resilience. Perhaps the most striking irony is this: the global debt system is built on trust. Trust that borrowers will repay. Trust that creditors will act rationally. Trust that markets will price risk accurately. When that trust breaks down, everything accelerates. Capital flees, currencies crash, and crises spread. So who are the hidden creditors behind global debt? They are pension funds safeguarding retirements, insurance companies balancing risk, hedge funds chasing opportunity, central banks rewriting the rules of money, international institutions enforcing order, rising powers extending influence, and states investing surplus for the future. They are not a single enemy, but they are not neutral either. Understanding them doesn't make the dead disappear, but it does something just as important. It reveals where power really lies in the modern world. Not always in parliaments or palaces, but in balance sheets, bond markets, and agreements most people will never read. And once you see that, you start to realize that global debt isn't just an economic issue. It's the architecture of modern power itself.